Executive Chairman of Yellow Brick Road Home Loans, Mark Bouris. Mark, so what do you think in terms of Phil Lowe? Does he recalculate here following Silicon Valley Bank and Signature Bank collapses?
I feel like doing a Mark McGowan moment and swearing, but I won't do it to you. I hope so, and I wish he had done it some time ago. To be frank with you, this is exactly what happens in these environments. So you only have to go back to the GFC period when interest rates prior to the GFC were very, very high, and all of a sudden you get collapses like Lehman Brothers and all those sorts of things. Every time central banks hike rates at the speed they're hiking them at, and particularly at the speed they're hiking at the moment, we end up, something breaks. And that's the whole program. The program is to break something. It's either break our desire to spend more money or something in the system will break because the system can't handle it, which has happened in the US. So my gut feeling is the RBA will be well aware of what's just happened in the US. They'd be saying, we don't want to break anything here in Australia. Not that our banks here are anywhere near capitalised the way they are in the US. We are much better managed and regulated. Yep. But I dare say they want to be very careful. But Pete, the terminal rate, what they call the terminal rate, is now in the market at 3.85%. So in other words, the market is predicting a 25 basis points increase in either the next meeting or the meeting after that, and that's it. Yeah.
So, and then we look at cutting. I mean, we just heard from Ed there, possibly by the end of the year. Do you suspect there could be a cut before then, or is that about bang on the money?
Nah, not by the end of the year. Look, I'm more an adherent to the Westpac view. The Westpac view is there'll be something up to 7 rate reductions towards the latter end of 2024. I think the RBA is going to say, look, inflation's still not managed, okay? Just because we've got a bit of a scare overseas, we still haven't managed inflation. I need to see the inflation signs reduce. So we'll stay at 360 or 385 at the cash rate for a period of time just to break the back of spending, and that sort of, it's quite resilient. So they're going to have to break the back of it. And I think it's going to take like 6 to 8 months to do that. Then we should see rate reductions, because then all the interest rate increases haven't hit us yet. The fixed rate turning to variable rate hasn't hit us yet. So let's just see how that all plays out. I think sometime next year.
I mean, it's such a tough job for central bankers around the world, isn't it? You can do as much as you can, but you know, Silicon Valley Bank and Signature Bank, they've proven that landmines can just pop up anywhere.
Well, yeah, that's 100% correct, but I think also we here in Australia have been quite well insulated, and just the same reason we didn't suffer a subprime crisis in the GFC period in Australia. We are much better regulated in our banking system. In fact, some would say during good times we are over-regulated. But it's when those over-regulations now start to play out and start to be, thank God, type moment, we start blessing ourselves. Yeah. Because the Australian banks are so well capitalised. I just don't think we're going to feel the same effects that they feel in the US. And I actually think what's going to happen in the US is they're going to start looking at Australia and going to start saying to their regional banks in particular, you guys have got to have a lot more regulation put around you. One of the things I think out of all this, Pete, is that people still panic here a little bit. So I think we'll start to see people in Australia move their deposit money into the big 4 or 5 banks. That's the big 5, the obvious ones. And as a result of that, those big 5 banks are going to become more flush with cash, and they'll have to do something with it, and more than likely they'll start lending it out. So we might see a bit of relief around that.
What about, I mean, we'll close here just back on, and this is getting very complex, so I won't dwell on it too long, but for Silicon Valley Bank, who was taking investments and reinvesting that money elsewhere, and then those assets didn't do very well, those government bonds started falling down. I mean, just more broadly speaking, was that actually a wise thing to do?
It made sense in that what the Silicon Valley Bank was doing is they're taking deposits from lots of people. So people deposit money, what they call short term, in other words, for a year or 6 months, whatever. And then what the bank has to do is lend it long term. That's what banks do, they lend it long term. And a lot of the money that they received, they thought, well, we'll put it into risk-free assets, which is government bonds. So government bonds are pretty safe. Yeah. But the government bonds are really safe. Because they're really safe, they pay really low interest rates. As a result of paying really low interest rates, when interest rates crank up hard, the value of those bonds become really small because no one wants them. So all of a sudden, they've got this mismatch and their asset prices start to decrease and people start to look at it and they go, wow, that asset price is getting really low. I want my money back.
Yeah, and then in social media has got a role to play there too for the panic and the fear spreading.
All of us have got a role to play, Pete. All of us.
Yeah. It's just a fascinating story, isn't it? Hey, Mark, good to see you. Thanks for explaining. We'll chat to you soon.